So I'm just going to dive right into it. We thought since this was the first show of the week, we would do a quick little, what is a dividend stock? 3 things you should look for in a dividend stock. Maxfield, what is a dividend stock?
I mean, a dividend stock, a lot of investors will probably be like, why are you guys covering such a basic thing? Well, the important thing to realize is that not everybody's at the same level of investing. And so when you're talking about dividend stocks in particular, there's a couple different types of stocks, right? There's like growth stocks that Tesla, companies that are 3D systems, other companies that are quickly growing. And then there are income stocks that they're not growing as quickly, they're more mature. But what they do, as opposed to taking the money that they earn and reinvesting that back into the business, they distribute that money to each quarter via dividends. And so, you could get buy a stock and get, for $100 and say get, $2 in dividends a year. And so that's what dividend stocks are.
Right. And I just want to point out that just because companies are paying out dividends doesn't necessarily mean that they're not investing in themselves. One of the things there's 3 things you want to look at when you look at dividend stocks: the dividend yield, the payout ratio, and the growth ratio. And the payout ratio, it tells you how much of a company's earnings are paid out as dividends. This is going to be expressed as a percentage. Generally, you want them to be below 100. If it's 100, that's like DEFCON 1, because that means they're paying out more than they make in dividends, and that's not good for anyone, right? Because you need that money.
So, and let's just break each of these metrics down. So, if you're a dividend investor, right, and you're out looking for a great dividend stock, there are 3 metrics that you start with. The first is the dividend yield, and what that is the annual dividend distribution divided by the share price. So let's say you buy a share, a stock that is $100 a share. It pays $2 a year in dividends, so 50 cents a quarter in dividends. That means that 2 divided by 100 would be 2%. So that's a dividend yield. And ideally, right, all else equal, a higher dividend yield is better for income investors than a lower dividend yield. But there are exceptions to this, and Gabby just mentioned one. So the second metric you want to look at is the dividend payout ratio, right? And so the question is, the dividend payout ratio, again, to Gabby's point, what it does is it is a percent, and it expresses the percent of earnings, of a company's earnings, that it distributes to shareholders via dividends. Now, as a general rule, you want to see this in the 30, 40, 50% range, because that means that not only is it probably a sustainable dividend, so even if the company's earnings go down a little bit, it'll still be able to support its dividend, but also because it shows that there will be an opportunity for dividend growth.
Of course, certain companies, though, are legally required to pay more dividends. The classic example are REITs, which are real estate investment trusts.
Exactly. So the size of that payout ratio isn't set across companies, like what is and what is not an appropriate payout ratio. So you have mortgage REITs, other types of REITs, other types of companies that, in order to get very special tax treatment, so you have pass-through tax treatment, so you're not taxed at the corporate entity, you're just taxed at the investor entity. In order to qualify for that, in many instances, for these specific types of companies, they have to distribute at least 90% of their taxable income, right? So you're going to have companies that just pay out a lot of money. And then the other thing to keep in mind is that you also have companies like AT&T and Verizon, right? Who these companies pay out a huge portion of their earnings and shareholders, sometimes even exceeding 100%. But what's important to take into consideration with telecom stocks and other stocks like that is that when you have companies that have a ton of depreciation from massive capital investments, that will decrease your net income, but you'll still have a lot of cash flow to fund your dividends. So in that situation, and this is kind of more of a nuanced technique, but in that situation, what you want to look at is a dividend payout ratio that uses not the net income as the denominator, but rather a company's free cash flow. So that's that second piece, that dividend payout ratio. And then the third piece that Gabby brought up is simply looking at how much
growth rate, by the way.
Exactly. Sorry, did you not? Maybe you didn't point it out.
Yeah, just in case people got lost in the explanation of dividend yield and payout ratio, we're talking about the growth rate now.
Yeah, and I don't know if there's anything you wanted to kind of talk about before I kind of chimed in with my own 2 cents on that, or?
No, you go ahead.
Yeah, so basically, and this is just really basic, right? When you buy a stock, you want your investment to grow over time. That's why you buy stocks, right? For that compound annual growth rate over time. And so, you apply the same philosophy to your dividend. You look at companies and you say, look, if I buy a share today as $100 and it's paying out $2 a year a share in dividend, but let's say their earnings are growing at 10% a clip. Well, in 10 years, and they're going to grow their dividend along with that, so they're going to maintain their payout ratio. What is that dividend going to look like in 10 years? Is that maybe it'll be $10 a share, right? So you want to keep that in mind. And really the best way that you can gauge that, besides looking at the dividend payout ratio, is just looking at at the company's history of dividend increases. If their executives have proven that they are committed to returning capital to shareholders, that should come through in the numbers over time, and it probably should project into the future.
Yeah, I do want to say one thing about the growth rate. Every once in a while, you'll have a company drop their dividend ratio, and that can happen for a number of reasons. One, maybe the company is in trouble, but two, maybe the company is expanding and they need that extra money to buy whatever other company they're going to buy or to invest in themselves. So a company dropping its dividend ratio isn't necessarily time to panic. You just have to do your research and figure out exactly why they're dropping it.
Yeah, that's exactly right. I mean, as a general rule, you should assume it's bad when a company decreases or eliminates its dividend, as a general rule. However, there are certainly many exceptions to that, and the only way you'll know in any particular situation when a company that you're invested in drops its dividend, whether or not that falls under the general rule or the exception, is, to Gabby's point, to really dig into the details of the explanation behind that drop or that reduction or that elimination of a dividend.